Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. Hey, everyone. I wanted to do a little state of the market, state of volatility and flows and things like that I usually like to talk about. So we can see the S&P here. A nice little rally back, and I think we can certainly attribute that to a couple of big flinches last week from Trump. Number one, we had this bond put. So we started to see cracks in the market as yields started to soar, which is the complete opposite of what he wants. But they started to soar as people were selling off treasuries. Really, treasuries and fixed income not really acting as that ballast lately. We're going to talk a little bit more about that. But the bond put showed up. That was a very, very big thing that basically kind of took disaster off the table. Right. So there was this sort of notion that no one cared about stock markets, and certainly Trump, least of all, the way that the rhetoric was happening. And basically everybody just figured we're screwed. This guy's just going to tank everything in an effort to get to this future dream reality that he's got. That is going to involve, onshoring and bringing manufacturing back and things like that, and sort of rebalancing the world from a trade perspective, et cetera. So that was a really, really big part of it. It wasn't so much that falling stocks really influenced Trump, and certainly didn't influence Powell, who didn't seem to be flinching over that. But the bond market helped, which in turn helped equities, right? So sort of indirectly benefited from that. And then later on in the week, we got this sort of possible exemption to certain products, semiconductors, cell phones, a couple other things, which was a big thing. Kind of quietly came after the close later on in the week, and so but had a little bit of a stabilizing effect as well. Now we don't know exactly how that's going. The messaging has been a little bit opaque there, so we're not quite sure. Does it mean those products are off the table? Apparently not. They're going to be reconsidering, but that they sort of get a reprieve. So we've gone from this, things are cracking, some of the financial plumbing maybe being a threat, to, okay, now it isn't Trump against the whole world, it's just Trump against China. China tariffs went up to 145%, and everyone else gets this sort of 90-day reprieve, which was enough for us to take worst case scenario off the table. So really big moment there. Equity volatility declining the most. Let's take a look at some of these things as we get into the gory details of everything. Equity volatility declining the most last week. VIX down about 8 points as stocks rebounded and fear seeped out of the market a little bit. The VIX term structure is still not perfect. We'll see that in a moment. Credit volatility, as you can see in the upper left here, credit volatility ended the week down a little bit, which is a really, really great sign. We want those credit spreads stabilizing. In contrast, we had currency, gold, oil, interest rate volatility all increasing. U.S. Treasuries, U.S. dollars sold off last week. So this is a very big thing. And so we've seen gold act very, very strongly. And I think that makes sense in light of the fact that the sort of flight to safety of treasuries, yet again, we've seen this over the years, where a 60-40 portfolio isn't really doing all that well, as bonds don't act as that stabilizing ballast. We saw the 10-year yield with the biggest weekly increase since 2001 on the back of, potentially maybe some inflation risk, rising inflation risk, although we saw very, very good inflation numbers recently. But certainly on the backs of extreme policy uncertainty, and maybe some other things that are going on here, such as who's selling these safe haven assets, right? So as we look to this potential new world of things being kind of re-rated and kind of rejigged a little bit, we sort of look at something like this. You can see foreign-based U.S. equities soaring out of U.S. markets, right? So big selling going on right after an amazing influx. This is usually when manias end, is when you see this big parabolic move. All this major money moving into this area, into AI, et cetera, which Torsten Slok talked about. He said this, things better work out with NVIDIA because it's a really, really big global bet on NVIDIA. And so things have really, really turned around. We can see money moving west to east, And so this is something that could have a little bit durability to it. I think at some point it's wrong and then it starts to come back. But for now, it still has some durability to it. And also people are sort of, there's people are talking about China maybe selling treasuries, selling their portfolio, even though that hurts them. This is what's happening as the world starts to turn away from U.S. exceptionalism and the sort of safe haven dollar status and fixed income in that sense as well. So really large kinds of movements underfoot. Let's go back to volatility here. That rates volatility surging higher as a result of all this. So that VIX TLT jumping over 60 points to a high of 190 basis points versus TLT skew. So that TLT skew had been sort of a little bit inverted since February as growth concerns weighed on yields. That's kind of steepening a little bit significantly. So I wouldn't say it was like massively inverted, but you can see that people are starting to pile in versus the sort of average for the year. This is your call skew, put skew on the left, call skew on the right. You can see people pushing a little bit more into that put side, right? That's where the skew is living right now on the put side. And what that means is when people are betting on downside in TLT, that means they're betting on upside in yield. So this idea that we're going to continue to push up sticky inflation, sticky pricing out there, even though I'm not buying into that completely. I think, if you sort of take out shelter, you're probably down close to 2% as it is, which is really good. And shelter is heading down, right? So shelter costs are, if you look at the chart on shelter, it is heading down. So there's definitely an influence from tariffs. You can definitely see that. And I think that some GDP numbers are actually going to be a little bit skewed a little bit as people go out there. I was buying a phone for my wife the other day and I felt this sense of urgency. I better get one before prices start to rise. So I think there's a lot of that going on out there on an individual retail basis, but also on a broader kind of stage of people going out and buying inventory and inputs and things like that they need for businesses. So, I think some of the data that we're going to see might be a little bit kind of not based in reality, in sort of the longer term reality of perhaps growth slowing and some of the difficulties that are going to come from pricing pressures from tariffs. But overall, I think generally, I don't think inflation gets out of control. But we'll have to see how that goes. So gold emerging really as that preferred safe haven, right? You can't run into bonds when they're getting crushed as well. And so you saw an increase in gold volatility last week as well. But equity volatility definitely kind of subsiding a little bit. Now, in the bottom left here, you can see SPX, S&P 500 intraday volatility highest since the 2008 GFC. So we have really, really seen some incredible volatility. And we showed that back here on the first chart here. Look at our ATR. I remember when August last year looked like one heck of a big rise, when then we came all the way down and we basically doubled it. This was sort of in the nines last August for that average true range. We got up to over 19. So an incredible doubling of intraday ranges as compared to last August, which was kind of a one and done a little bit. So we acknowledge that we came back pretty quickly. This is more durable and certainly more violent from a realized volatility standpoint. Realized volatility just meaning actual movement that we're seeing out there. Those very wide ranges, those huge runs up, huge runs down, and those big daily ranges that we're seeing here as people try to figure out what the heck is going on. And then S&P versus equal weight volatility, very interesting. That SPX versus SPW, that equal weight realized volatility, really, really huge in the larger market cap part of the index. That S&P 500, very weighted in those Mag 7s that have been suffering quite a bit lately. And I've really been talking about that in terms of what I saw if we bounce back. Now, I didn't see the Trump news coming in last week, but I said, listen, what we're probably going to get is a very big, hugely correlated rally, because that's what we got on the way down. That initial sell-off into a sheer panic, which we talked about, that sort of there is no bottom kind of mentality, that comes with everything correlating to one, everyone throwing out the baby with the bathwater. We got the relief. We've come all the way back, and I've been saying in a number of shows and places that I thought we're going to get that whoosh back into the market. Now we're going to become a little bit more selective in terms of what's going to start performing. So you look at a day Like yesterday, we kind of had, a move back into real estate, consumer staples, utilities, a little bit in financials there. But you can see discretionary down there, energy, healthcare, information technology did okay, I think, considering. But really, my idea is that really they don't start piling necessarily into the NVIDIAs of the world again. The Microsofts, the NVIDIAs, yes, these companies do fantastic, but I think they're doing potentially less fantastic. We saw that news a couple of weeks ago from Microsoft, kind of dialing back some of the digital investments. So, we may be looking at an actual slowdown. And we've had big companies say, listen, if things slow down, we may have to reevaluate our CapEx spend. So what that means to me is that we're going to continue to see things like SPLV, those low volatility areas, things like Walmart. We saw Walmart start to break out a little bit yesterday, continuing to see those kind of more recessionary defensive plays, like, in my view, Netflix, which Josh Brown just piled into today for all the reasons I've been talking about for months. Netflix, Costco, safety plays, but then, they're not cheap, names like that. But in terms of other areas that are a little bit more defensive in nature, TJX, some of the sort of J&J, things like that, Colgate-Palmolive, can be some boring, but some exciting. But it's going to be probably sort of what you might call safer names. Here's that correlation again, that gold TLT. Look at your TLT since last September, really kind of almost at the time of the election, really, really underperforming, and gold really taking off. So this has become, and forget Bitcoin, it's done okay, but it's still really, digital gold hasn't been doing as well. So people have run into the real deal, the multi-millennia proven value of gold has really, really won out again. So here's our VIX term structure, a little bit not great. You can ignore April, that's expiring, so it has to sort of converge with the cash, the VIX cash here. So we see VIX at 29. That's today. So this is going to disappear. So really what you should be looking at is everything from May onwards. And we're still backwardated, right? So front still above the second, above the third, above the fourth, et cetera, et cetera. So certainly not out of the woods by any stretch of the imagination, a little bit better than what we've been seeing lately. And then I hate to say it, but one interesting thing is, if you look at what's happened again, as people have as the market has come back, we've seen people replenish their hedges. So that's pushed up downside skew in single name, in index as well. So people starting to really kind of position with those fresh hedges again, and you're seeing this skew kicking up in QQQ, in the S&P, in the Russell, which has been just terrible train wreck. We can see that skew really soaring, and look at the difference between upside calls. So this is where, if you thought that we still had a little bit of upside, you'd sort of look at this and go, well, look at expensive skew, getting really expensive skew, certainly in the Russell and QQQ, very, very steep on the put side. On the call side, we are absolutely plunging into the depths. So look, call skew hitting the lows of the past little while in S&P and the QQQ, and in Russell just falling off a cliff. So look at this risk reversal right here. You can sell this downside put skew to buy some extremely cheap call skew in something like Russell. So if you really did think at some point we're going to stabilize and maybe start to look towards those back half of the year sort of benefits of regulation and maybe some rate cuts and things like that, then something like this is kind of really starting to line up. Even though this is sort of short term, this is probably a good proxy for what's going on across the term structure to some extent. And this creates that sort of everyone focusing on the left tail and ignoring the right tail, and that creates a little bit of opportunity. Or if you just want to play upside, that upside isn't necessarily very expensive. So now, the only thing that kind of keeps us away from something like that is maybe this realized volatility is extremely high still. So I want to see this come off. We saw the ATR start to come off. I want to see that 1 month realized volatility come off. Why is that? Well, we're going to get some help if that happens. So let's take a look at some of these CTA flows, which I think are very important. So this is something that could lend a little bit of a tailwind to stocks here. If you look at the systematic positioning, so what this does is it combines these three things: CTA, which is the basic systemic. Think of those as all kinds of different systemic sort of strategies outside of vol control and risk parity. Vol control allocates to stocks when volatility comes down, And when volatility goes up, it gets out of stocks. Risk parity, again, sort of allocates based on volatility of the underlying asset, et cetera. So think of these as, I like this term here that is being used, impulsive supply, right? So it's like the Terminator. These strategies, they vary to some extent, of course, but they really have strict rules. They're not emotional. They don't kind of assess on a daily basis in terms of what are they feeling markets are going to do, what do they feel markets are going to do. They literally just act, right? So when volatility goes up, they do one thing. When volatility comes down, they do another thing. So very, very systematic. And if you look at these strategies, they have really de-risked. Look at this, sitting very near, not quite, but very near the lows of 2020, the lows of the global financial crisis. So from that perspective, look at this, 1.2, this 1.2 percentile on a 3-year look back in target volatility and vol control. Those are the ones that allocate to volatility to the market based on low volatility. These have completely delevered, right? They've come out of the market and they're sitting there. So you no longer have this supply from this whole world. This supply isn't so much there anymore. They're sitting at very low levels of long allocation, right? And CTA, same kind of thing as well. So, and in fact, they're short in Russell, Topics, Nikkei, et cetera. They're long some of these other ones, NDX, DAX, et cetera. Risk parity, still 31st percentile in terms of exposure, so that has maybe a little bit more room to the downside. But CTA around 17.8%, and vol targeting extremely low. So from that perspective, maybe there's an opportunity for things to stabilize a little bit more. We've kind of had the baby out with the bathwater. We have this incredible skew that is sort of ripe for the picking. I think there is a chance we could get down to those lows that we experienced lately, maybe around 5,000. Again, I don't think we make new highs on the VIX. I don't think we necessarily get a whole lot lower in the index, but we are going to continue to have a trader's market where things like this can be taken advantage of, right? You're playing downside, you want to use some put spreads. You want to use maybe things like broken wing butterflies, maybe some flies. Upside, nice fly opportunities as well. In areas where you want to gain that positive delta, maybe have a little bit of short Vega exposure to the upside in case volatility gets crushed a little more, which it could, right? I mean, you look at the VIX still around 30, there's plenty of downside there. So I think there's ways to play things both ways in this market. And so good luck to you all, and we'll see you in the next video.